$950. The new increased charitable subtraction, we used to say it was above the line meaning that I subtracted it. I didn't have to go through itemized deductions to get this. I still don't go through itemized deductions. They moved it. They now call it, I'm just saying this so that you're not confused by it. They call it a below the line deduction. And the reason for that is they moved it down one line. But the issue here is that I take my gross income and I can subtract off, if I'm a single filer, $300 of receivable charitable giving, $600 if you're married filing joint. In 2020, that had only been $300 for a married couple. In 2021, it's been doubled to $600. A couple things you need to understand about this. It's a subtraction, not a deduction, which means I don't have to itemize to get this. If I itemize, I use my itemize and I don't take this. If I don't itemize, I can take the subtraction provided I can receipt it, that I actually have proof that I gave it. This is not some automatic number that we can just throw down there and not worry about being challenged on it. We do have to have receipts or proof that we made those contributions. Those contributions need to be in cash. They cannot be goodwill. So a lot of people are going to say, well, I give $600 to goodwill, so I'm going to take that $600. Goodwill would not count for this subtraction. It has to be actual cash or cash or in lieu of cash, check as an example, transferred stock as an example, given to a charity. And there's one more charitable allowance. This one may impact some of you out there if you're high givers. In the past, your cash contributions were limited to 50% of your AGI. So if you had $40,000 of income on your tax return and you wanted to give $30,000 to a charity from somewhere in your portfolio, you had those savings laying around, you would have been limited to $20,000 because that's half of your $40,000. The other $10,000 you could carry forward to the next year, and if you itemized, you could use it there. If you didn't itemize, you could continue to carry it forward, but it only carried forward for 5 years. After 5 years, it was forgotten about. Now, in 20 and 21, they've moved that benchmark to 100% of your AGI. So in that example I did, the entire $30,000 would be deductible as an itemized deduction. The issue to remember here is that starting in 2022, that'll drop back down, not to 50, but to 60%, because that was the 2017 Act that said we could go up to 60%. So we just have to kind of watch that number. If you are a high giver, or if you're doing something, which I'm about to talk about, called doubling up, or some other method of increasing your charitable giving, you do have to be mindful of the fact that you have that limit out there. If you exceed that limit, you're going to be carrying it forward, and you could, if not itemizing going forward, lose that. So do pay attention to that. I'm going to stop here and let Paul tell me if we got some questions. I do see some stuff coming up in the Q&A. What do you have out there for me, Paul?
Well, Ken, there's 2 questions. The first one is, can find the RMD life factors tables.
Okay, can you say that again? You broke up.
Where can one find the RMD life factors tables?
Easiest place to find those tables would be to go to the IRS webpage, and in their search box, put in life expectancy tables. Now, when you look at a life expectancy table, that's what the required minimum distribution looks at. There is single life and there's joint life. So you're going to have to look at how you're filing as to which one you're going to look at. And then there's some age issues there. So you got to make sure you're in the right chart to begin with. The other way to do that is simply go to the IRS webpage, or not the IRS webpage, but Google required minimum distribution for, and fill in your age. So required minimum distribution for a 73-year-old male, as an example. Google will probably take you to that table, but it will also answer that question, tell you what the percentage is, or it'll tell you what the percentage is, and then you have to apply that to your IRAs. The third way that I would tell you to do that is contact the custodian of your IRA. The custodian will also provide for you that information as to what your required minimum distribution is based on that IRA. If you have multiple IRAs, remember that you can combine that up and you can choose which IRA you want to take that out of. I will talk a little bit more about that when we get to the section on retirement benefits, because the required minimum distribution comes up there. But that's a very good question. Thank you for asking it.
The next question is from Mark Saltzman. He wants to know, during the 10-year period which the IRA or Roth IRA must be distributed, can you take all the distributions in the 10th year, or must the withdrawals be distributed over the 10-year period?
You have the option. Whether you take any money in the first year or not makes no difference. With the stretch IRA, you had to follow a pattern. And if you didn't take that distribution each year, then you had, at the end of the 5th year, they were going to make you take it all. With this new 10-year rule, they don't care when you take it, the level that you take it, or the frequency that you take it. But in that 10th and final year, whatever's left in the IRA is going to come out. So let's say that I skip the first 9 years. I don't take anything. In the 10th year, whatever that IRA is at is going to have to be drained out. If I were sitting with my heir that had just inherited this, I would look at their tax return and try to balance those distributions against the tax return and against their individual setting. What kinds of income do they have? I would time them out based on that tax return, number one. Number two, I would encourage them to take some off of that every year, because there's two things that you're worrying about if you just leave it accumulate. As it accumulates, it's just creating more taxable income down the line. Number two, most people, when I speak with them, I just polled 1,400 tax preparers, and not a one of them would raise their hand to the question, do you think taxes will stay level or go down? The belief out there is that taxes will increase. The reason for it is we have a burgeoning national debt. And with a burgeoning national debt, you can ignore it only so long. At some point in time, we have programs out there that do need to be supported. We have Social Security that needs to be protected. We have an infrastructure bill that was long needed. We have so many decaying roads and bridges out there. These are costing a lot of money. You cannot do that at the same time as you're reducing taxes. Somewhere along the line, we are going to see increases in taxes.
Okay, thank you. I want to go back to that first question. I didn't phrase it correctly. It's from Arden and Jean Trine. And the question is, where can the new tables for 2022 be found? The new RMD life factors tables for 2022. I'm gonna
stick with my original answer. You're still gonna probably find them the easiest by going into the IRS webpage, irs.gov, and searching for those tables. There'll be a chart in there. But if you go out on Google and you word your phrase as to that's what you're looking for, I guarantee you that you will get to a site. When you use Google versus the IRS, when you're using the IRS, you're getting the IRS's, you're in their page. They may send you out to a page, but they're going to send you to the page you're looking for. When you go to Google, be cautious anytime you use Google to do research, because the first several hits that come up are going to be ads, and they'll say ad right on them. I would skip those. I would get down to one of them that is a tax, like a CPA or an EA tax page, where they're just giving you the information, as opposed to those pages that are ads you're gonna get blitzed with advertisements for whatever company is trying to show you that table. But that, to me, that's still the best way to find them.
I've gotten some advice from Robert Schuler, who says that my audio is breaking up, and he asked that you repeat the questions that I
Okay.
posed.
Sure.
Kathy Lewinsky wants to know, what does the CARES acronym stand for?
Oh, that was on that slide. The CARES acronym stands for the coronavirus aid. Now I got to get it back in my head. And hang on 1 second here. I had it written down. It stands for the Coronavirus Aid Relief, that's the R, and then Economic Security, that's the E and the S. And it was designed simply to, for the most part, not create a lot of tax laws. It was created to ease the tax laws that were out there, give you more time. That was where you got the chance to draw out of an IRA and not have to pay the tax right away. You could put it off for 3 years. You could avoid penalties when you took it out. So it was all things that were meant to relieve the burden. The biggest thing it gave was all those free loans out to businesses.
Paul,
Okay.
Paul, a recommendation, Paul?
Yeah.
A recommendation is when you're talking, turn your video off and your sound will do better. Leave your
Thank you.
sound on, but turn your video off.
Okay, thanks, Don. Don Miner is our technical expert this morning. Rick Daluge wants to know, is this withdrawal from IRAs that are inherited the same for Roths and regular IRAs?
Correct. They lump everything together: Roth, traditional IRAs, non-deductible IRAs. It doesn't distinguish between them. It's just saying that they have to be drained within that 10-year period. Of course, the taxation for each one is going to be different. The traditional IRA is going to be fully taxable. A non-deductible IRA is going to have basis in it, so it would probably not be taxable. And then you're going to have, except on the gains that were in there would be, because in other words, they have a basis. So a non-deductible IRA that started out as $7,000 that was put into it may have grown to $15,000. $7,000 is non-taxable, the other $8,000 is. And then you have your Roths. With the Roths, again, they have to be drawn out in the 10-year period, but there wouldn't be any taxability in the Roth because that was the deal. That's what the IRS and Congress agreed when you opened up that Roth.
Rick Dodge also wants to know your thoughts on conversions to Roth IRAs. Will income taxes go up in the next few years?
Conversion I'm going to talk about conversions later, but that's another topic where it depends on what you believe. I don't really have a crystal ball. I have an intuition that simply says taxes will probably rise. The question is for who? Under the current administration, they want an increase in taxes, but those are only going to be on people or incomes in excess of $400,000. The question of conversion is a little complicated. It's based first and foremost on what do you believe the tax laws are going to do, and so you're taking a bet. You could lose that bet. You could wind up seeing that taxes didn't change, and you paid taxes worrying that they were going to. The second thing would be who is that conversion meant to be used by? Is this something I'm going to use down the line, or is this something I'm going to give as an inheritance to someone else? The motivation is slightly different. If it's I that's going to use it, well, then is it going to sit there long enough for me to have made or gotten any advantage by paying those taxes on my own ahead of time? If it's going to an heir, it's, am I trying to protect the heir from having taxes and I'm just willing to pay the taxes myself? Or do I believe they're going to be in a higher tax bracket than I ever was? Or that I fear this 10-year rule that says they're going to have to take so much out so fast that they're going to create tax burdens for themselves. So the conversion is not a very cut and dried, simple answer. It's based on a lot of different situations for each individual. And first and foremost, you have to be able to pay those taxes from some source of revenue other than the conversion. If you take it from the conversion, you've defeated the purpose.
And the last question.
Yep.
The last question in for this section, Ken, comes from Shelley and Fred. They want to know, what is the RMD table? How and why would you use this? We are newly retired and not at RMD age at this time.
The RMD table, when someone has to take a required minimum distribution, it's based on their age each year. It starts out around 3.6% of your IRA. So if you had a $10,000 IRA, they would tell you had to take out $360. Next year, that percentage increases, and it increases slowly over your age until at one point it reaches the highest it's going to get to, and that's around 10%. If you outlive your IRA, an IRA under the former tables, I haven't looked at the new tables. I in fact never memorized those tables, but we all knew that at age 114, you would hit 100% of your IRA. In other words, at 114, they decided enough's enough. We're tired of seeing how long you're living. We want your IRA out, so you got to take it all. If a person dies, normal age, somewhere between, let's say, 85 and 95, somewhere in that time frame, they're never going to wind up with more than 10% in a given year. But that's what those tables are. I would rely on the custodian of my IRA, who is required by law to tell you each year what that required minimum distribution will be. If you have multiple IRAs, you add up all those required minimum distributions. They're given to you basically in late December or early January. You'll get those for the upcoming year. You can add those all together and decide where you want to take them from. In other words, you could take them all out of one IRA. You could take them out of a combination of IRAs. You could take more from one IRA than another, but collectively you have to hit that total. So let's say you have 3 IRAs. The first IRA says that you have a minimum distribution of $5,000. The second IRA is small. It says you have a minimum distribution of $800. And the last IRA is your largest one. It says you have to take $10,000. Well, the total of those 3 IRAs is $15,800. $10,000 plus $5,000 plus $800. That $15,800 I can take from anywhere I want. Let's say that my largest IRA has done really well. So I'm thinking, why don't I take some of those gains off of there? I can take that RMD from there. So it's a calculation based on your age, but the custodian keeps track of it for the IRA. And there is no such thing as an IRA without a custodian. There's always a custodian. Someone has to be in charge of monitoring that IRA and doing that calculation. Those people that like to look at the table are using it as a means of trying to plan and think ahead. But as I said, the most accurate information you're going to get is going to come from that custodian.
Couple more questions have popped up on this very hot topic.
Okay.
First, from Mark Saltzman. He poses this: what is the problem with holding money in the IRA? Let the money in the account grow with luck and pay tax then. rather than making withdrawals and paying taxes along the way?
Are we talking about conversion there, or are we talking about someone who's falling underneath that stretch rule that says it has to all come out? I'm not sure of the direction of that question. My opinion about IRAs is until I had to take money out of them, I didn't. The purpose of the IRA was to shelter that income from my tax return. Yes, the growth is eventually going to be taxable, but that's going to be a manageable distribution down the line. So if he's saying, you know, the idea of trying to draw down your IRA to reduce the RMD in the future, I agree with him. I would leave it in there. I would leave it in there and leave it grow. I'd worry about the RMD when it came up. The design behind an RMD at age 72 is that we've kind of got our income on our tax return under control. We're probably doing Social Security, maybe a pension, maybe drawing some income off of our dividends that are reportable on the return, but certainly not equivalent, not comparable to when we were working and bringing in a married couple's case, two full-time wages. So yeah, I'd leave it in there till I had to take it. I hope that kind of got to the question.
Okay, thank you. One last question. You mentioned that Roths must be emptied out eventually. Will Roths be treated like RMDs eventually? Please elaborate on this.
They won't be RMDs because in your lifetime, the owner of the Roth, unlike an IRA, does not have a required minimum distribution. It's the heir that is a non-spouse. So if my Roth goes to my wife, she still doesn't have to take anything out of it in her lifetime. But when she passes away and it goes to her beneficiary, which is probably my daughter, then my daughter will have to take those out, but they're not considered RMDs at that point in time. It's just simply that 10-year rule that says empty it. We don't care how, we don't care when, but by the end of the 10th year, it better be empty. I think that answers it. If we can, I'd love to move on, and you can store up if you got more questions. We can always, throw some of those out again at the next break and then again at the end. But I'm going to move on at this point and keep my presentation going so we can get to the end. I really appreciate these questions. They're good questions. Doubling up deductions can still work. So what we're going to do in this next section is we're going to look at saying, okay, well, they took itemized deductions away from me, or at least they made them less attractive, less efficient. When the standard deduction went up, as an example, under the old standard deduction, when it used to be $10,000 for a married couple, if I had $35,000 of itemized deductions, well, I was benefiting by 25,000 of those because that's how much I exceeded the standard deduction. Now the standard deduction is sitting at around 25,000. My $35,000 of itemized deductions is only really benefiting me by $10,000 because I could have had the standard deduction anyway. I could have taken that. So as a result, either because the itemized deductions have been limited, so I can't even get above the standard deduction, or because the standard deduction is so high that my itemized deductions aren't as efficient, we need to go back to the old ways of trying to make them work better. And one of those was doubling up deductions. I will tell you that doubling up deductions still works. As a backdrop for those of you that maybe hadn't ever heard of it or didn't know about it, doubling up says that I can pay more charitable in 1 year instead of spreading it out over multiple years. So let's say that I give my church $10,000 a year. Under the current setting, $10,000 plus my $10,000 of max taxes is not going to beat the standard deduction of $25,000. But if I were to give my church 2 years at once, so instead of 10,000, I'm going to give them 20,000. Now 20,000 plus my $10,000 of income taxes gives me $30,000 against a $25,000 standard deduction. I get $5,000 of benefit out of that. The question that has to be answered is, where did that money come from? Was it worth taking that much out of your portfolio at once? Was this a good time to do that sort of thing? So doubling up works, but we have to be cautious. The other thing, under the old doubling up rules, we used to double up our real estate taxes. We would pay one set of real estate taxes in January. By not paying them in December, we'd just let them drift over to January of the next year because we were allowed to do that. And then in that very same year, at the end, when my new tax bill came, I paid it all in December. Well, I had two sets of property taxes in the same year. That's been done in, I'm not saying it doesn't, it can still be done, but you're limited to $10,000 of income plus real estate taxes. And in most cases, the average real estate tax out there is probably in the $5,000 to $6,000 range. Doubling it up says it's not going to work because you're going to exceed that $10,000 number and you're going to lose all the excess anyway. So it's not going to really help you. As I said, in some cases where the real estate taxes and the income taxes are low, doubling up that real estate taxes may be what gets you up to that $10,000 max. Now combined with your doubled up charitable, you might make it work. Watch for high medical combined with charitable. That's a person where doubling up would probably work. I have medical coming through and I'm a pretty good charitable giver. Doubling up could work for you. Consider transfer of appreciated investments as to where do those funds come from. When you transfer appreciated investments, you're getting the fair market value. So again, as an example, I have a particular stock that I paid $8,000 for when I invested. It has grown. It has been it's done a really good job. And now that $8,000 investment is worth $15,000. I can transfer that stock to the charity. I don't get an $8,000 contribution. I get a $15,000 contribution, and I don't have to pay the taxes that I would have paid had I sold that investment, taken the $15,000 in cash. In that setting, I would have had $7,000 of taxable gain inside there. Giving the whole $15,000 later to charity would give me that $15,000 deduction, but it wouldn't get me out of this tax on the $7,000. So be cautious about those things and utilize that as your method. One more way to aid doubling up. We've talked about these in the past. They weren't as popular as they suddenly have become in light of this problem with itemizing, and that's donor advised funds. So I need to make sure you know how they work. First off, when you put money into a donor advised fund, you're actually putting it into an investment, but that investment is going to ultimately belong to whatever charities you give it to. It's not ever going to come back to you. So don't think about it as an investment in that sense. Think about it as an asset that you've given away today to get a full charitable contribution, but you'll dole the money out of that fund over a period of time. And that period of time is up to you. It's your choice. With a donor advised fund, if you put a bunch of money in there and each year gave some out to charity, between the growth of the fund and the fact that you weren't giving all of it out to charity, somewhere along the line you passed away, the balance of that donor advised fund would go out to the charities you had named. It would not come back to your family. It would not come back to an heir. It would never come back to you. That's the first thing you need to understand about a donor advised fund. It works because you gave the money away. You get a full charitable contribution in the year the funds go in. You have a one-time, you can do one-time contribution and never put any more money in, or you could do multiple year contributions. You could do multiple contributions within the same year, add them all together for your deduction that year. You're not limited by how that money goes in. The donor can determine the timing of the distribution. So you can tell the custodian of the donor advised fund when you want the monies to go out to your charities. So if you normally gave money to your church in December, you can tell the donor advised fund, send all that money that I just, let's say I choose $5,000, send $5,000 of the fund to this church in December. You could do monthly distributions, but that's going to be up to the donor advised fund to be that flexible. We'll talk about that in a little bit. The donor, you choose the charities. And again, you can choose as many charities as the donor advised fund will allow you. Some donor advised funds have no limit. So you can have as many charities as you want. Each year you can change the charities. So here's an example. I'm going to give $10,000 to my church on an annual basis, but I can't itemize because $10,000 just isn't enough to get me over the standard deduction. So instead, I go to my portfolio and I pull out some money. It could even be appreciated stock that I transfer to the donor advised fund. Instead of putting 10,000 in there, I'm going to put 50,000 in. I'm putting $50,000 in there. I get a $50,000 deduction this year. That definitely allows me to itemize. And then over the course of the next 5 years, I'm going to tell them to give $10,000 to my church every December. In year 2, the church changes ministers. I don't like the new minister, and I've now decided to search for a different church, and I find a new church to go to. I now go back to that donor advised fund and say, instead of this church, instead of church A, I now want it to go to church B. So I have the right to pull and change that charity anytime I want to. This allows me to change my mind about where that money goes. Now, someone's going to come to me. I know I've heard this so many times. They're going to say, well, why don't you just give the 50,000 to your church? Won't that work the same way? The answer is yes. But in the ensuing years, the church is going to go, you just stopped giving? We're not getting any money. Some people don't like that feeling. A second reason for not giving it all at once, I may not be in that church 5 years from now. I may have changed my mind about that charity and I don't really appreciate the way they're doing business or who they're giving their money out to. So I would have liked to not have given them the 50,000. So the donor advised fund gives me that delay, gives me time to think about which charities do I want, gives me control. It makes it appear and feel to me as I'm still being charitable every year. A lot of people refuse to do doubling up when I explained it to them, because they said in that next year when I don't give any money to my church, I feel really uncomfortable. So, we used to give them a card to put in the collection plate. Well, a lot of people just don't like that feeling. The donor advised fund gives them an option to do charitable every year, but take all their contributions in the year they put the money in. The donor can choose from the investment strategies offered by the custodian, but I will tell you they're not going to be very aggressive, and you don't want them to be aggressive. You want this money eventually go to the charity. Here's the worst case scenario. I put $50,000 into a donor advised fund and I choose the most aggressive investment I can. And over the course of the next 4 years, the market's been very bad. 2008, 9, 10, remember those years? We tend to forget them, but they exist. Okay, during that time frame, instead of having 50,000 in my donor advised fund, it's dropped down to 35,000. Well, that's less money than I can give out to the charities. The good news is I got my $50,000 contribution when I did it. I didn't have to adjust that because the fund lost money, but I don't want the fund to lose money. So I want to be fairly conservative in my investment. Before you go to a donor advised fund, do the research. Look for flexible terms on transfers and distributions. They shouldn't be limiting you. The less they limit you, the better. Consider the investment options. What are the things that you can invest in? If there aren't any really decent investments in there, well, find a different donor advised fund because there's lots of them out there. And then finally, watch out for high fees. They are going to charge for the fact that They're using mutual funds, and mutual funds have costs inherent inside them because they're always trading. They're always buying and selling stocks. But they're going to also increase those fees because they're doing this distribution for you. They're sending out checks. They're keeping track of these charitables for you. Well, because of that, their fees tend to go up. Watch for ones that charge a too high fee. I think that those fees should be less than 1%, would be a targeted number. That's one approach. Here's a different approach. This approach is completely different. You need to understand that. In the previous one, we were trying to make itemized deductions work for us. We were using a method of bumping them up so that we could get a lot of deduction one year, and then over the ensuing years, just take the standard deduction with nothing to show for it. With this one, we're going to skip itemizing altogether. We're saying, well, it's too hard to itemize. You can't itemize. Let's just find a different way to do it to get our charitable out of there to satisfy my soul, but also to do something in a way that I don't have to pay taxes on the money that I go after. And that's doing qualified charitable deductions from my IRA. It's actually qualified charitable distributions. I like to use the term deduction so that you understand how it's working. You're really reducing taxable income. It has to be a qualified charitable organization. You can't put these, you can't do this qualified charitable deduction into a donor fund. I'm going to repeat that. You cannot do a charitable distribution, an IRA distribution, into a donor advised fund. That's not allowed. It has to go directly to a charitable organization. When we say directly, it cannot be distributed to you. If it's distributed to you, it will be taxable. If it's distributed to the organization, it will not be taxable. It has to come from an IRA, not employer plans. I'm going to repeat this one too. A lot of you have 403Bs or TSAs. I don't care which term you use, it's the same. You cannot make qualified charitable distributions from those employer plans. They have to come from IRAs. If you want to do this and your money is sitting in a 403B, I would advise that you take part of your 403B money and move it by transfer into an IRA so that you can then do your charitable distributions from that IRA. If you're in Fidelity for a 403B, just move it from that 403B with Fidelity to an IRA with Fidelity. It won't cost you any money. You will now have a pool that you can use for qualified charitable deductions. The owner must be 70 and a half. We thought that they were going to raise this to 72 to match the minimum distribution change. They did not, and it appears they will not. They're going to leave that at 70 and a half. This year, in August, I turned 70 and a half. I can now go to my IRA and start making my charitable contributions by direct transfer from my IRA. I will pay no tax on that money when it comes out of the IRA. That is a win-win. I will have satisfied my my charitable urge. I will have made my charity happy, and I will have taken money from my IRA that I don't have to pay taxes on. And by the way, by reducing that money from the IRA, I've reduced the amount of money that my kids will get from an IRA and probably increase the amount of money that might come to them from my other plans because I didn't have to take my charitable giving out of those. So it's a win-win-win-win for everybody involved. You transfer to charity satisfies required minimum distribution. So if you're 72 and you have to take a minimum distribution, let's say your minimum distribution is $8,000 from your IRA this year. Well, that's going to have to come out of the IRA. But wait, if I want to give $5,000 of that to charity, let's transfer $5,000 to charity take the other $3,000 in cash. I'll take that. I've satisfied the minimum distribution. I'm only going to pay taxes on $3,000 instead of $8,000. If I transfer the entire minimum distribution to a charity, I report nothing on my tax return. No inclusion in income. But remember, this is to avoid having to itemize, so there is no charitable deduction. We already got it up front. Why does it work? There's no income inclusion means no tax. Adjusted gross income stays lower, which means it'll reduce my Social Security that I have to pay taxes on. It'll keep my Medicare premium. It could keep my Medicare premium lower. If you cross $175,000 of income, and I know that there are people in the audience who, if you take minimum distributions in cash, or you take distributions from your IRA in cash, you will cross that $175,000 threshold by adding in all of your Social Security. 85% of your Social Security is taxable. All that IRA money, plus your pension, plus your investment money, you suddenly cross $175,000, and next year your Medicare premium isn't $140 anymore a month. It jumps up 200 some. So that's a benefit. And then finally, it reduces reportable income. Even though I didn't itemize, I still reduced my reportable income. So here's an example. I did the best I could with this one. First, the facts. For this couple, they have income from Social Security and from pension. Their Social Security is $16,000, their pension is $18,000. We'll show you later, but you take that $16,000 plus $18,000, if you add that up, you're at $34,000. In this case, they'd have $1,000 of reportable income from Social Security. That's how much they exceeded it by. That would mean their total income is now $35,000. The 16 plus the 18, I'm sorry, it's not $35,000. It's 18 plus 1,000, which is, I knew I'd make a mistake this morning when I tried to do this. I'll have to fix this slide. 18,000 plus 1,000 would only be 19,000. Because basically your Social Security isn't taxable until it crosses with your other income, 32,000. In this case, 16 plus 18 was 34. They crossed that line by $2,000. 50% became reportable. That's $1,000 of their Social Security. Just 1,000 plus the 18 is 19,000. I apologize for that error in there. Now let's say that they decide to take $5,000 out of their IRA, either because they had to, it was a required minimum distribution, or they just wanted to give money to charity. So they took $5,000 out of their IRA, put it in their checkbook, and gave it to charity. This increased their taxable Social Security by $2,500 because that $5,000 is now added to that amount that's over $32,000. Half of that becomes reportable. That's $2,500. Now they have 18,000 plus 1,000 plus 2,500. What is that? 35. They're not 42.5, but 21.5 would be their reportable income. Now we go down to the bottom. By giving 5,000 to charity, what did they wind up with for total itemized? Well, let's say that their total itemized with taxes that they paid in and the charity that they gave, the $5,000, came to $17,500. Well, their standard deduction was $27,800. They have the standard deduction. They do not benefit from their itemized deduction. So they added income to their total taxable income, but they didn't get any benefit by giving it to charity. That's the difference. That's how QCD can work. I think I'll run through these next ones. I'm going to come back. Actually, I think I'm going to stop, Paul, because I can see a lot of questions in the Q&A coming up. I can't see them, but I can see the numbers. So I'm betting that last two topics I talked about has generated some issues. So throw me some questions.
Well, actually, interestingly, many people who asked questions a few minutes ago, you answered them with your slides and your discussions.
That's because That's because I do have a crystal ball. I can
You
see into the
do.
future and I know what those questions were going to be.
Yes, you do. But here's one. This comes from Mark Saltzman. He says, by controlling when you pay medical expenses or any deductible source, can't you essentially get a benefit that is doubling up?
So when you control, say that one, what is he in control of?
Is medical expenses. If you can control when you pay your medical expenses, can't you essentially consider that as a benefit? Wouldn't that be doubling up?
Yes. If you can control those medical expenses, there's some problems there. You really can't, you can't double up premiums because the insurance company isn't going to let you prepay your insurance for several reasons. That would mean that they might miss their increase that they would do in October. The second thing is that the government in that setting says that you cannot prepay anything that is due on that annual basis, like medical premiums. You certainly can't control your Medicare premiums. Those are coming out of your Social Security. Long-term care, that would be one you could control. With long-term care insurance, I could elect to go to a 5-pay or a 10-pay as opposed to a life pay. When a person goes to a 5-pay on long-term care insurance, they're agreeing to pay a much larger premium over the course of 5 years. And in fact, they could, if they had a bunch of money laying around, do a 1-pay. But here comes my caution. My caution in that is, since that's one that I can control and feel like I'm doubling up, if I have enough wherewithal, enough money laying around to do that kind of thing, I may not be a person that is a good candidate for long-term care insurance because it looks like I can afford my bills from income, and then all that money paying into insurance isn't going to get me anywhere. It's going to protect income to someone else down the line, but not necessarily to me. So with medical, I agree. If you can control certain bills, another big one would be my wife has to have a crown. Well, we can decide to have it this year, or we can decide to push it off till next year. So in that setting, if you had a bunch of dental work, you had hearing aids, you had glasses, those are medical expenses that you could lump together by good planning. How much benefit do you get out of there? It's going to depend on your AGI. It's going to depend on the rest of the itemized deductions. But yes, it could work.
Okay, here's a final question about RMDs and qualified charitable contributions. If you use a qualified charitable contribution from your RMD, does that affect your standard deduction?
Not at all. Not at all. The standard deduction is a flat number. It's just out there. You can use it in a lot of cases. People don't even need all of the standard deduction anymore because it would eliminate all their income. In the example that I just had up there, the standard deduction would eliminate the income from that person in the first part of the example. So no, taking a qualified charitable deduction will not impact your standard deduction. You still get the full standard deduction.
And another question from Susan, this is from Susan Reich. She asks, where can I find someone to consult on this complex topic? I think I could save a lot of money with more direction / consultation.
There are lots of texts. I mean, I could shamelessly send you back to my old firm because I know that this is what they do. But there are a lot of tax planners out there. The key is go to a tax planner, not a tax preparer. A lot of offices out there will advertise that they're a tax preparer, and that is in fact all they do. They take your information, they do your tax return, they file it for you, and they tell you this is what you get back or this is what you owe. But they don't sit down and say, but next year this is what I think you ought to do, because that's going to save us some money. You need to, when you